It's time to start thinking about your portfolio in 2022. So in this video, we'll start with some analyst forecasts for the year ahead. We'll also look at valuation for US equity, but also international equity, for gold and for corporate bond markets. We'll also look at monetary policy because that's about to change. And we'll look at some tail risks for your portfolio because those are events which might cause a drawdown over the next 12 months. So at the end, we'll draw it all together with two potential tilts for your portfolio based on what you think is going to happen. So let's look at where to invest in 2022 in a bit more detail. So before we start, let's ground ourselves in some very simple base rates. And in the world of investment, the base rates to remember are the long-term returns for various asset classes, with the highest usually being from the equity market. So this is the return since 1900 based on research by Dimson, Marsh and Staunton, and this is a return above inflation. So equities by far have outperformed other asset classes. This is for the US equity market, but the same is true of global equity. So if you are going to be investing over the long term for a decade or more, say, then it makes sense to put as much money into equity as you possibly can. For comparison, bonds have only returned 2.1% over that 120-year period. And T-bills, which are like short-duration government bonds, which are very cash-like, have returned only 0.8% above inflation. So if you remember nothing else from this video, just remember the base rates. And that most of the time it's best just to put your money into equity over the long term and just leave it. Now let's look at some analyst forecasts for the S&P 500. The blue line here is the S&P 500 since the beginning of 2017, and the red lines you can see above me are the broker forecasts for the end of the year in 2022 for the S&P 500. So they range between 4,400, that's the lowest forecast, all the way up to 5,300 for the S&P. Now I've also shown the forecast for the end of this year, which were made about 12 months ago, and those are above me here. And it looks as if we're going to beat every single one of those forecasts. So it's certainly been another blowout year, because to beat analyst forecasts, remember they're always optimistic, is an incredible thing. What's even more remarkable is that exactly the same thing happened the previous year. Nobody expected that during a pandemic, the S&P 500 would beat the most optimistic analyst forecast. We started this video with a warning about base rate neglect, which is a cognitive bias. Another cognitive bias is recency bias, where you just look at the returns over the previous 12 months, say, and you extrapolate those into the future forever. So after a period of very strong returns, you expect those very strong returns to continue. Well, here's evidence that analysts at investment banks are also subject to recency bias, because if you actually extrapolate over this period since 2017, the average return has been 15.7%, which is very high. And in fact, if you extrapolate that trend to 2022, you can see that we end up pretty much in the middle of those forecasts, with a value for the S&P 500, which is just a little bit below 5,000. However, if we push back the analysis further in time, all the way back to 1990, you can see the average growth rate of the S&P has been about 8.4%. Now, sometimes it's lagged below that rate of growth, sometimes it's above it, but what you can see here is that the current rate of growth is twice that average, and usually that means reversion back to that long-term trend. We don't know when that's going to happen, but it always has in the past. With that in mind, let's take a look at US equity valuation. Robert Shiller has come up with a valuation measure called the CAPE measure. That's a cyclically adjusted price to earnings ratio. And recently he adapted it to come up with a version that also incorporates interest rates. Because when interest rates are very low, as they are now, that tends to push up valuations. So by incorporating that into a new measure called excess CAPE yield, we can assess whether the US equity market is expensive or cheap. So on the right-hand side of this graph, excess CAPE yield is high, and that means that US equity is cheap. And over on the left of the graph is when US equity is expensive by this measure. Now, each one of the dots on this graph shows you on the y-axis what the 10-year returns were for the S&P 500 in the decade that followed that valuation. So you take a snapshot of valuation on day one, you look at the excess cape yield, that's the value on the x-axis, and then on the y-axis is the return for the S&P 500 in the decade that followed that valuation. Now this measure is most informative when it's at extreme values. So when excess cape yield is very high, that means US equity is cheap, and you can see that the returns in the decade that followed typically were also very high. Whereas when equity markets were very expensive by this measure, the decade that followed usually gave very low returns. And that makes intuitive sense. When markets are expensive, you'd expect returns would be lower over the next decade. And when markets are cheap, you'd expect high returns. Unfortunately, the current value of the excess cape yield is one which is kind of intermediary. It's not particularly expensive or particularly cheap, and that means it's not particularly informative either. If we plot how that measure's changed over time in this bottom panel, when excess cape yield is above the dashed blue line, it's considered cheap. So I've shaded this graph blue when US equity starts off the decade cheap. And when we're below the dashed red line, that's when US equity is expensive. And I've shaded that with red blocks. Then this top panel shows you the return in the decade that followed. So in 1920, for example, the US equity market by this measure was the cheapest it's ever been. And sure enough, the equity return in the following decade was also very high, at over 20% on an annualized basis. 1950 was also picked out as a very cheap time to invest, and again you can see that the equity returns were very high over the decade that followed, between 1950 and 1960. And currently we're still seeing that cheap period following the global financial crisis, which was a great time to invest. So that's the period since 2009 to 2019. But as you can see at the moment, we're still sandwiched between expensive and cheap on this measure. But if we do get an equity market sell-off, this is a great indicator to look at to see when equity becomes cheap, and it's a great buying opportunity. So this is one to watch in the future. Vanguard has also created a variation of the CAPE measure, which they call the fair value CAPE. This is how it's varied since 1950, and what it shows you is when the cyclically adjusted price to earnings ratio shows that markets are expensive or cheap. So for example, the dot-com bubble really stands out as a very expensive period. But using this measure, you can see that currently equity markets do look expensive. Another very simple valuation measure that's worth looking at is the forward price to earnings multiple for the S&P 500. That's the price of the S&P 500 divided by the forecast earnings or profits generated by the stocks in the S&P 500. Now that forecast is based on optimistic analyst forecasts, so it tends to flatter the S&P to look cheap. But even that measure is currently above its 5-year average, that's the dashed green line, and also its 10-year average, which is the dashed blue line. So this is another indicator that's worth looking at when equity markets tumble, to see when there's actually a bargain to be had. And currently this one is also indicating that equity markets are still very expensive, although it has been coming down recently because earnings growth has been very strong in the US. If we take a look at the US earnings growth or profits growth historically, we can see the effect of the pandemic because it took a huge chunk out of corporate profits. But what's also remarkable is how quickly the US equity market recovered and profits very quickly rose far above where they were before the pandemic. And this pattern of crash, huge surge is one that we see if we look at almost any economic variable, including inflation. Unfortunately, the third stage in that crash and surge is a kind of meh period, where earnings growth goes back to fairly tepid rates as they were before the pandemic hit. If instead of levels we look at year-on-year growth for the S&P 500 profits, you can see the effect of the pandemic here in Q2 of 2020 with a fall of 32%. Then we had the huge surge which followed, and then here's the meh period when earnings growth goes back to quite boring levels. So I think this poses a risk for US equity when we get back to this boring everyday growth rate, which is not very exciting at all. We can also decompose the S&P's growth into two components. One of them is based on how much people are willing to pay for profits, and the other one is the fundamental growth in those profits. Fundamental growth has been pretty good since 2013. Earnings have grown by an average of 8.7% per year. But the rest of the growth of the S&P has been due to re-rating. People paying more due to animal spirits. That kind of euphoria that we saw with meme stocks, but also with cryptocurrency, is unfortunately a fairly unreliable thing. And if the animal spirits start to dissipate, there could be quite a lot of downside for the S&P. So this is why valuation is important, because you realize what the fundamental supports are for where equity markets are right now. It's also interesting to look at valuation for other markets. So this shows you the CAPE measure across different countries. But what I've done here is compare it with each country's history. So for example, the Netherlands has never been more expensive than it is right now based on Shiller's CAPE ratio. And at the other end, Turkey has seldom been cheaper. So if you are a contrarian investor, perhaps you'd buy these countries which are at the cheap end of the spectrum. And you'd probably keep away from the countries where euphoria has pushed equity prices to incredibly high levels. So that would be the Netherlands, Taiwan, the USA, and India, for example. However, I'd be a bit cautious about doing that because it's interesting to look at the winners and losers over the period since the beginning of 2021. The winners you can see above me, which are scaled at 100 at the beginning of the year, and the losers are underneath me. Now what's interesting is that many of those countries whose equity markets have sold off have done so due to political reasons which were very much a matter of choice. For example, China has effectively sabotaged its own equity market because of political priorities. Turkey has abandoned the idea of an independent central bank, and it's not a coincidence that inflation there is surging. And Brazil and Chile have both gone with populist governments who are spending too much, and that's rattled markets. But politics is very difficult to predict, so I'd personally be quite cautious about buying those cheap countries, because they are cheap for a reason, and likely to stay that way for some time until the politics changes. It's also interesting to take a brief look at US sectors. Now these numbers are scaled based on the values just before the pandemic sell-off, and you can see that technology, consumer discretionary and materials are by far the biggest winners over that period, whereas defensives like consumer staples and utilities have underperformed, as has energy. Now generally when we've seen interest rates rise sharply, technology has been the sector which has suffered. So sector performance will almost certainly be affected by monetary policy and interest rates. Now, monetary policy is likely to change dramatically in 2022. If we look at the Federal Reserve, for example, they've already started tapering their asset purchases. They were buying $120 billion worth of treasuries and mortgage-backed securities, but they've already started to cut back their rate of purchases in December 2021. And if they stick to their schedule, taper will end by the middle of 2022. Now, they may accelerate taper or slow it down based on what happens with markets, but also the economics. The next big question is, when are interest rates going to increase? When will liftoff occur, as it's called? My guess is that that'll probably happen by the end of the year. And if we look at market probabilities backed out of the futures market, there's a wide expectation that we could have an interest rate increase as early as March. And the probability of increased interest rates before June is actually almost 80% now. This is the dot plot from the Summary of Economic Projections, which is published when the Fed's FOMC committee meets, and these dots represent where committee members think interest rates will be in 2021, 22, 23, 24, and then in the longer run. Nobody expected an interest rate increase in 2021, whereas in 2022, several committee members think it's going to happen. Only one member thinks there won't be a rate hike by 2023, and by 2024, everyone expects rates to be higher. And then in the longer run, it's also interesting to look at the level of interest rates where we're going to end up. Now that's 2.5%, and that's a pretty high level which markets may have difficulty digesting. But certainly for now, if we look at market expectations for the end of 2022, they're pretty much in line with those dot plots. What generally causes a dislocation in markets is when the Fed hikes faster than expected. We're also seeing an interesting dislocation in the gold market. Now for Patreon members, we have a very simple model that has just 3 inputs. One of them is inflation, but there's also the strength of the dollar. That's the top panel because gold is priced in dollars. And when the dollar's weak, that's good for gold. And we also look at the yield on bonds because when yields are high, that's generally bad for gold because it's a wasting asset that generates no income. And if we plot that simple model's fair value of gold going back to 2004, where the model is here in red and the actual price of gold is in blue, you can see it does a fairly good job of fitting the price. Until that is the pandemic hit, when there was a big dislocation between the fair value from the model and the actual value of gold. So the fair value at the moment, according to the model, is about $2,400 an ounce, whereas the actual price of gold is far below that. That's closer to about $1,800 an ounce. Now for our Patreon supporters, we give full access to that gold model, but also access to Slack, so you can discuss investment with me and other members of the community. And there's also a growing library of members-only videos, which you would get to vote for. To learn more about that, just click on the link beside me or in the description below me. Now let's take a look at corporate bonds. And what this shows is for 4 different credit ratings for US companies, how much additional income you receive for taking their credit risk. So for AAA companies, of which there are very few, on average, historically, you've got about 0.7% extra income. Whereas the lowest of these 4 ratings is single B, and there on average, you'd have got about 5% additional income. But there, of course, you're taking greater credit risk. Now, when equity markets sell off, generally what you see happen is that these spreads spike. Now, a bigger spread means the bond prices fall, and that represents a buying opportunity. That was true in March 2020, and it will always be true in future. But if we look at the spreads right now, you can see that they're very compressed. People just aren't pricing in much risk in the corporate bond market. So you're really not compensated for taking that risk, and this is not a good time to buy US credit. But this is certainly one of the asset classes which is in my market crash shopping list, so that if something like this happens, risk appetite falls, corporate bond funds would also fall in price, and you could buy into them at a much lower price. Vanguard's got an interesting model which forecasts a decade ahead. And it's called their Vanguard Capital Markets model, and it's based on Monte Carlo simulation where it looks at valuations. So if valuations are very high, usually that would project a lower return in future. And that's why for the US, the projected returns over the next decade are very low. They range between 2.3% to 4.3% annually. What's also interesting is that for the next decade, they think value will finally recover. So that'll return between 3.1 and 5.1%, whereas growth, which has done incredibly well for a decade, is kind of centered around a 0% return. That's where we see the really egregious valuations in the US right now. Also interesting, there's no discrimination between large cap and small cap. Both will have approximately the same return according to the model. And because US equity is so expensive relative to the rest of the world, they think that global ex-US markets will perform better than the US. There the returns are between 5.3 and 7.3% per year, and emerging markets are pretty much in line with developed markets. So if you did believe this, you could buy developed market equity excluding the US very cheaply. Usually they'll be around 0.1% or even lower. Fixed income, according to Vanguard, will continue to be boring in the decades ahead, with returns of between about 1% and 2.2% for treasuries. Even high yield will only give you between 2.2 and 3.2%. And I suspect that's because of the very tight spreads that we can see right now. And because they think inflation will be around the Fed's target of 2% over the coming decade, it's not really worth buying inflation-protected securities. Now let's turn to the tail risks, which are low probability events, but which nevertheless have a high market impact if they do occur. These are the biggest tail risks according to a survey by the Federal Reserve, and this is part of their Financial Stability Report, which was published in November 2021. The biggest risk in November was seen to be persistent inflation. Maybe the Fed's got it wrong and inflation's going to stay high for a long period of time. And given what's going on with Omicron at the moment, people are worried about vaccine-resistant variants of COVID. Sticking with the news items, we've got the China regulatory risks. Which sector's going to be next? What will the property development sector fallout be, both for Chinese growth, but also for markets elsewhere? And with this ongoing spat between the US and China, how's that going to affect markets? And then an interesting new one is the effect of cryptocurrencies and stablecoins on financial markets generally. And I did make a video about how that contagion could actually happen. It's easy to get scared by all this stuff, remember, but these are low probability events. And you really shouldn't allocate based on things that are very unlikely to happen. But just be wary of these risks in case they do start to materialize. Now, I speak to a lot of people in Power Hours, which is one-to-one coaching sessions, and I'd say the primary worry is the one about inflation. And the scenario people imagine is something along these lines. Inflation is not transitory, it remains persistently high, and then the Fed's response is to raise interest rates too late. And as a result, that means it has to raise interest rates really fast. So here you can see behind me a car slamming on the brakes. Because what they fear most is a Fed that has to raise rates very rapidly. And as we've seen recently, that tends to be bad for tech stocks, particularly large cap tech, which very much dominates in US markets. So that could generate quite a big drawdown for the US and for markets elsewhere. And if you follow Mohamed El-Arian, who was the ex-PIMCO bond manager, he's kind of obsessed with the policy mistake from the Fed. In fact, he's come up with almost one tweet about it every week over the last 2 years. So maybe there's something in it. China is a perpetual worry for strategists but also investors, and what's interesting about this graph, which is taken from one of the Vanguard reports recently, it shows the sensitivity of other economies to a slowdown in China. So Brazil, which exports a lot of raw materials to China, is very sensitive. It's the most sensitive country based on this analysis. South Korea, also very sensitive, as is Japan, Germany, and South Africa. They also show how recent changes in China's economy has changed sensitivities of economies to its economy. So the old economy index was dominated by things like textiles and mining, but the new economy index, which takes into account how China's growth is evolving over time, depends on other sectors such as healthcare, high-tech manufacturing, and innovative green technology. So Brazil becomes less sensitive to this new economy index, and South Korea becomes much more sensitive. So I think if the Chinese property sector does affect the rest of the world, it'll be via this indirect channel. A slowdown in China will have ripple effects for these countries which are tightly economically linked with China. So now let's draw all of that together. I think overall the backdrop for equity in 2022 is a good one. We can't see huge amounts of leverage in many markets across the world, banks are well capitalized, and credit is easily available, and interest rates are still very low, even if they start to rise. I think towards the end of 2022 there could be a wobbly period, and as we've seen in the US, by several measures, valuation is very high, particularly in some sectors. And when you combine that with higher interest rates and slower earnings growth, I think that might be a problem. But that is towards the end of the year. Now, some people I speak to are very worried that inflation will spike or that interest rates will increase to very high levels. So if you're in that camp, then I think gold makes sense as a hedge because that is less interest rate sensitive than, say, US Treasuries. And if you are going to buy Treasuries as a hedge, you'd go for shorter duration ones because those will lose less value if interest rates increase or if inflation increases. And if you are going to tilt your equity portfolio, this is the kind of environment in which value will finally outperform growth. My personal opinion is that we will see inflation start to ebb in 2022, maybe not back to 2%, but certainly not at 5% as it is now in the US. We'll also see the US yield curve flatten as interest rates are raised at the short end, but the long end gets pinned by low growth expectations. Now, in that kind of environment, growth will continue to outperform value. So that's what I expect is going to happen in 2022. That also means that tech megacaps, which have done so well over the last decade, will continue to outperform. And if you do want a US Treasury hedge against the possibility of a fall in equity, then you'd go for the middle part of the curve. So that would be the 7 to 10 year range for US Treasuries or for UK gilts. So I hope that's helped you structure your thoughts about what's going to happen in the year ahead. Why not share what you think with us in the comments below this video? And of course, remember the Patreon offer. We'd love to have you as part of the community, and it's a great way to learn more about investing in the new year. And as always, thank you for listening.